Hey, CFO friends, welcome back to the Budget Bitch podcast. I'm your host, Farah Turcott, your mortgage broker and money coach. Today, we have a really exciting episode for you. I'm joined by James. He is an emerging advisor in the financial services industry, with at one point in time being the youngest financial advisor in his credit union he previously worked for. And in the last year, he started his own practice as an investment and insurance advisor with the small but mighty team that I also work with at portfolio planning. Ooh, tongue twister. To help better serve his clientele through providing comprehensive and unbiased advice, which that is the interesting piece that we actually will get into a little bit more later,
Mm.
as well as planning and product solutions. And you also sit on the Company of Young Professionals and Entrepreneurs Leadership Council with the Abbotsford Chamber of Commerce. So that's super cool. That's amazing. And he also holds a certificate in financial services advice and responsible investment specialist designation, and working towards the personal financial planner designation this year. Oh, big stuff coming your way, hey?
Fingers crossed.
All right. Well, thank you so much for joining me today, James.
Thank you for having me. I mean, this is super exciting. Been wanting to have some chatting on a podcast for quite some time with you, so this is cool that we could do this.
Yeah, it's so nice to be able to connect in this way, and I know you have a lot of really great nuggets of wisdom from your time now being independent, but also from your time earlier in the past at the credit union too. So, should
Yeah,
be an exciting one.
yeah,
So, can you tell us a little bit more about your story, why you do what you do, like why financial services, and maybe your experience also from going from the credit union to going independent and how that transition has been for you?
yeah, totally. Kind of what got me interested first in like finance as a whole was grade 10. We had a planning class, we called it. And so we did like resume building. We also did a stock trading simulator, which seems in hindsight a little bit interesting that we were learning how to trade stocks, or at least trying to, when, you know, there's more to just trading stocks, and trading stocks is very risky, as we both know. And so, but it got me interested, and I finished like second place in like how much money I made in like this fake money trading simulator. And I was like, okay, this is kind of interesting. And my mom works in finance, my dad works in sales, and so I got to see, and my mom's also self-employed, so I kind of got to see, you know, from my parents growing up, my dad in sales and like the interacting with his customers and clients, and same with my mom. But you know, I always liked seeing what mom was doing, but I liked to see how dad did things, and I was kind of like, okay, where am I going to fall in that? And so I was originally going to go to university for a track and field scholarship and study business. Didn't end up feeling like that was going to be my calling for at least that time, but I still wanted to pursue something financial services, let's call it, related. I just wasn't sure. And
Yeah.
so after some trial and error, and, you know, just chatting with parents and seeing, you know, kind of brainstorming really, came to the thought about, you know, working at a credit union. Thought it'd be a good kind of like foot in the door, you know, starting point, and just see where it would go really. And I was a teller for a few months, and then already had my investment course for my licensing taken care of at that point, and became one of the youngest, well, the youngest advisor, at least at the time, at like the ripe age of just under 21 years old. So 20 years old,
Wow.
it was like, I'm inviting people like 3-4 times my age. Like that seems kind of backwards, but you know, I put in my work, I put in my hours, and I was fortunate enough to be put in that position with that much, you know, responsibility. So
That's amazing. That's such a cool story. And like you grew up with both of these from your parents, both of these experiences and insights, I guess. And then you kind of were just able to find a way to bring that together into your own forging your own path and your own career. So I think that's so awesome. Yeah. And such an inspiration also for young people who I know often in the finance industry, there's a lot of folks who are obviously much older, and
mhm.
sometimes it can feel like there isn't a space for those of us who may be younger or maybe like newer to the industry, and it can be really intimidating. So I find that super awesome that you just dove in anyway. Yeah.
Thank you. Yeah, the intimidation part is definitely there. I will say that, and
Yeah.
imposter syndrome can creep in a lot. I know we've talked about that in the past, and it's a very real thing. But I think it's good to have that in some ways because it keeps you in check. Because when you Tyson on the team with portfolio planning, we're chatting about this because it's like when we feel like we know everything, you truly realize that you don't know anything or don't know everything.
Yeah.
Kind of example. And it really resonated with me. And so yeah, it's nice to be younger in this industry and started earlier. And I couldn't have really started much earlier if I'm being honest. But it's definitely nice to have. Yeah, it can be interesting and intimidating at times having like more seasoned professionals like myself being surrounded by, and it can be intimidating, but I try to look at it more as like they have experience and wisdom and knowledge that they can provide me rather than, oh, I'm just not good enough to be around them kind of thing. I try and
Oh,
just look at
yeah.
it like soak it up like a sponge approach versus like I'm just not meant to be here. I'm trying to learn kind of thing is really how I go about it.
That's such a good approach as opposed to feeling or thinking like you know everything, and that it's the learning's continuous, especially in this type of business. So definitely a good approach to have. Can you tell us a little bit more too about how clients can work with you and why clients work with you, and kind of explain to us a little bit more about that?
Sure. Yeah. When I was at the credit union, I'll back up a step. I was just doing investments. So like mutual funds primarily and investment plans and financial plans. And so it was really nice that I got that experience. And I knew it can be very hands-on work in some ways. And I do like that because you could go in, I've said this before in the past, and you can go into a meeting like, you could have two meetings in the same day. You're meeting somebody that may be like, the same demographic, same age, same job, same income, but you could have two completely different financial plan outcomes. And that's what I really
Yeah.
want. It keeps you on your toes. And so I really wanted to keep that component of it. But when I left the credit union, I left because I saw there was inefficiencies kind of with maybe the business model and some other things. And I wanted to kind of take what was good from my experience there and move it over however I could, and then incorporate insurance into that. So to answer your question, I do investment planning and advising as well as insurance planning and advising. So anything to do with if somebody is starting to save for their first home, retirement, anything really. That's even if they just have questions and they're like, I don't know how long I have to save or what I'm saving for. That's where you come to an advisor like myself, and then we help kind of game plan with you. We're kind of like we're like the coach, or the quarterback. We're there to
Yeah.
put you in the right position. I'm not there to rule what you're doing with autonomy and do everything for you. I'm just there to put you in the right place to succeed, as however that looks like. If that's growing your money on the investment side or protecting your money on the insurance side, because if you grow your money and then you don't have protection for it, what's the point of growing it if it's just going to be depleted if a bump in the road occurs, which it will. It's just a matter of when. But yeah, that's like a pretty high level overview of kind of what I do and what people can kind of expect from me. But yeah, I like to have that comprehensive approach. I don't want to just be a one trick pony. I want to do a little bit more than that, but I don't want to be like doing everything. Like I know you're doing lending. Like lending, I got to do at the credit union. Not my cup of tea. It's very tedious, and I would rather have somebody else do that. So
Yeah.
I focus on what I'm good at and what I enjoy, and but especially what I enjoy, because I find that it's my passion to be. I don't want to just help you grow your money. I want you to save and protect your money, and so I feel like it just is a very nice holistic approach to it, if I could kind of say it that way.
Yeah, I love that type of approach, and I totally get that because um for you, lending is not your favorite thing, but I find it absolutely fascinating. So
Right.
that's like why I chose to specialize in that area. And for yourself, like you have this holistic approach, which I think is so important and I think can really be applicable to almost every aspect of finance, no matter what discipline you specialize in, because um, if it's just if there's only one solution or if there's only one piece of the puzzle that we're looking at, the rest get ignored, and that could be doing a disservice to our clients. So it's important to look at the whole picture for sure.
Very true. Very true. And I'm also not there to pretend like I'm going to do everything in the picture. Like there are
Yeah.
like corporations. I'm taking a corporate tax course right now so I can get more familiar with working with corporations, but I'm not about to pretend that I'm like doing corporate financial planning. Like I would refer out to that because that currently that's not in my tool belt, at least in my words. So
Yeah.
what I'm good at and what I'm maybe where my weaknesses lie, or I don't have strengths there yet, I have other people on the team or that I can reach out to fill that gap. So
Yeah. Same for me in like commercial lending. Like that's not my forte. I'll be the first to admit it. So kind of what we really wanted to also talk about today was issues that young Canadians are currently facing economically, and as a result can trickle down emotionally as well, and just overall financial well-being of young Canadians today, which I know there's quite a lot that's been discussed, whether it's on the news, on social media, um, just all of the things that we as young Canadians are facing today, like food inflation, housing affordability, and also housing assets making up a significantly large portion of net worth, which in turn makes us more vulnerable to fluctuations in the housing market. So I kind of wanted to talk about that and kind of your take on that and what you're kind of seeing right now.
yeah. What I would first touch on there is when we talk about like people's net worth being made up a lot of like the equity they have in their house or houses, let's say primary residence as a whole, is I remember my time at the credit union. It was still when I was a teller. It was just before I moved into the advisor role, and I was talking with one of the advisors, and he had a meeting at near the end of the day, and then we're leaving the branch for the the day's over, and I was asking, oh, like how'd your meeting go and stuff, and he said, oh, I just met with these people that are in like their mid 60s, kind of late 60s, and they have like no retirement fund. And I was like, well, how are they gonna survive? He's like, well, and he called it, and it's always stuck with me, they're house rich, they're cash poor. So they're house rich because they have equity in their house, they paid off their house, they own, it's free and clear, but they have no retirement fund. But for a lot of people, and a lot of people I think got very lucky with the housing boom that we've had in terms of just like the cost of housing go up, because a lot of these people, at least that I've seen, and maybe you too, have had maybe like really neglected saving for retirement. And then they have this housing boom in 2020 to like 2022 in Canada, and their house goes up like 40-50% in value. And now they're like, now they can downsize and they have like, some money left over for retirement, and they can, live maybe the same lifestyle or similar lifestyle, depending on if they're working or not. And so that's something that a lot of like nobody expected that to happen, but it did happen. And so a lot of
Yeah.
people, I think the best way to put it is like they got lucky, because if they didn't have that housing boom, I personally don't. If we could go back in time and like if there was preventative measures to make sure that didn't happen, for example, have like a sufficient housing supply, because supply and demand is what it
That's a
comes down
big
to,
one.
right? That would
Yeah.
be much, much better. But we can't change the past. All we can do is just influence the future. That just also prices out people out of the market, because there's no chance that somebody our age in their 20s, Gen Z, maybe even millennials on the younger end, are going to be able to afford like a single family detached home. So
Yeah.
it's kind of crazy just to hear like also, yeah, to the point of how much money people's net worth is made up of in their house. A lot of people think, oh, buy a house, pay it off, and then I'll focus on retirement. But really, it should be simultaneously focusing on retirement and paying off your house. But a lot of people treat their house like their glorified retirement fund. And so, at least in Canada, if you have your primary residence, at least with the current tax rules, and you sell it, you don't pay capital gains. So it's kind of like a glorified tax-free savings account, but you want to be careful because you're also exposed to the fluctuations of the real estate market. So
Yeah.
yeah, definitely pros and cons to that.
Yeah, like depending on, if you're trying to time a sale of your primary residence, it could be depending on the fluctuations of the market. And, maybe that's the money that the proceeds is the money that you're intending to use for another purchase or something else going on in your life, then you are obviously far more susceptible to like lows in the market or
Right.
changes happening in the market. So that's like something to keep in mind. And the fact that wages have just not kept up with the cost of housing,
Yeah.
and it's just exponentially, the two lines on a graph just
Yeah.
exponentially have grown further and further apart. And like, I actually also wanted to share a study that was done by Sagen, who are
Oh yeah.
Canadian mortgage default insurers. And they did a study this year on financial fitness and homeowner trends with people who were already homeowners and also prospective homeowners. So the results I'm going to share are just for those who are just not yet in the market. They did like a total of 2,103 interviews with Canadians 18 plus back in March.
Okay.
So they found that financial fitness, they flagged with falling to May 2020 levels. So in the early stages of the pandemic, as Canadians are just to the highest inflation since the 1980s and the highest Bank of Canada overnight lending rate since 2001. 59%, I'm just dropping the stats here. 59% said that they have confidence in their long-term financial health. 40% are able to pay all their bills and save some money. 42% are concerned about making ends meet month to month. So that's pretty significant. 13% had to draw on savings to pay their bills. 74% worry about missing out on the home they want because of rising prices. 37% mentioned uncertainty rather
Mm.
as one of the top home shopping challenges. The sirens are just going off here in a Surrey city center. 59% worry about not being able to afford mortgage payments because of current interest rates. 47% having to compromise on location for affordability and commute.
Mm.
And finally, 49% having to settle for a smaller home due to affordability. So quite interesting stats there that they just
Mm.
released. Yeah.
Yeah, there's a lot to take in there. And I can share a story from my time at the credit union when I was doing lending services, so like mortgages, lines of credit, like secured lines of credit to homes too, like HELOCs.
Mhm.
And for those, HELOC stands for home equity line of credit, just FYI. I try not to use the lingo when I know people that maybe don't
Yeah.
understand are going to be listening. But when I was doing that kind of lending and we saw the interest rates begin to rise, we had a lot of mortgages on the books that had just by chance come from brokers, and there's nothing wrong with that. But a lot of these instances were people that got qualified like in mid 2020 at a very, very low rate, variable rate too, so even lower because that's typically lower than the fixed. And on top of that, so they had like borrowed like $1 million, $900,000 to then purchase their home. And then interest rates begin to rise. And so at a certain point, so for those that don't know what a trigger rate is, once you reach a certain point in terms of interest rate increases, you're no longer meeting your contractual obligation to pay off your mortgage in time, basically. So if you're supposed to be paying like $2,500 a month, and maybe the math is that like, 1,000 of that goes towards your principal or what you owe, and the other amount goes to interest. Basically, all 2,500 was going to interest, and you had to increase your payments, mandatory, not optional, to meet your contractual demands. There was some times, Farah, and this was really tough having these conversations where people that, regardless of the amount they had borrowed, like we're talking like high, like $800,000, $900,000, their mortgage payments were going up like $2,500 a month, like increasing from
Mhm.
an already say 2,500 or so. And people are like, well, what are my options? And unfortunately, from a lending perspective, your options are either make the payment or you sell the house to pay for the debt, because you signed, unfortunately, you did sign saying that you would be able to pay this. And some people may, they get all their ducks in a row and they get the lending. And then after they get the house or whatever and approved for the mortgage, then they go crazy and they spend and they get a car and they, get a line of credit and do renos. And like, I get it. Like, you worked hard and you saved hard and you want to reward yourself, but you got to think like, you're already saying hey, I'm putting some skin in the game here. And I'm saying I'm going to be able to pay off this home. And, we never anticipated rates to rise as fast as they did and how much they did, even just that.
Mm-hmm.
But wow, it was tough seeing and having some of those conversations with people being like, you got to, if it means taking the kids out of sports for a little bit, if it means to, you just had to be creative. And they were receptive. They were definitely like, this is really like frustrating, but
Yeah.
like, there's nothing, nobody saw this coming. And that was the tough part.
Yeah, it was also interesting because most economists did not and could not, they weren't able to predict this, and
Right.
nobody had thought that rates would rise as quickly as they did. But now, as the variable rates are starting to slowly come down, there's this understandable optimism that rates will come down like as fast as they went up, but that's likely not the case. Obviously, I don't have a crystal ball, but
No.
I don't think people should be expecting that or waiting around for that. And I also just wanted to share, this was released by Stats Canada, navigating socioeconomic obstacles, impact on the well-being of Canadian youth. So there's quite a lot here. Young adults are struggling to afford housing as they spend more of their income on shelter than older age groups. So 63% of those age 15 to 29 are rented their home, compared with the national average of 33%. That could be a few factors, like you might be living at home, um, you might be renting on your own as a result. Like maybe a lot of first-time home buyers are, not all, but many are dual income households, or they're purchasing with a family member, that sort of thing. So that totally makes sense. Youth were more likely than those aged 40 and older to report being very concerned about their ability to afford housing or rent. So 60% versus 37%. And a higher percentage also of young adults are choosing not to have children for financial reasons compared with older adults. So fertility rates are decreasing across all age groups. This is a trend that began a few decades ago. However, affordability concerns and lack of access to suitable housing were more recently cited as factors influencing the fertility intentions of Canadians, in particular those age 20 to 29. Age 20 to 29, more likely to believe that their financial capacity and adequate housing would act as barriers to them having a child, compared with adults aged 30 to 49. So there's that delay as well of having kids if they want kids. And youth in general are less satisfied and less hopeful about the future than in previous years. So that's a little, it's a lot to take in.
Yeah, the fertility one really, really saddens me just to think. And I did hear, I think it was a news article or something. I don't know if it was the news I was watching or what it was, but I did hear that though recently, and it was talking about, a lot of people are delaying when they'll have kids, or at least reconsidering their plans to have kids purely because of affordability. And I playing like the devil's advocate here, like I understand why. And I think we all
Yeah,
understand why, because
100%.
how like that's an extra mouth to feed. The cost to raise a kid from birth to age 18. This is like an old stat, but it said it was about, I think this is in Canadian dollars, it was over $180,000. And now that was factoring in inflation. And depending on when that survey came out, I think it was like in the 2010s, earlier in the 2010s, that number is over $200,000 now. So if you're taking that, dividing that by 18, you're looking at over $10,000 extra per year that you need to set aside or have readily available to raise, this little human. That's huge. And so I understand why a lot of people are doing that, because they can barely make it on their own, or with like two incomes. Let's say two incomes is, mathematically speaking, better than one. But it's really disheartening hearing that and just thinking that people are delaying their family plans, their lifelong plans of having children, and being a mom and a dad to just live or survive, really. So
Mhm.
it's tough to hear that.
Especially for those who, do want to have kids, and that's something that they've always, had in the back of their mind and their plans of what they want to do. Obviously not for everyone, but those that do, those are really sad statistics to read, and it's like a probably and it is actually a harder time than ever before, um, to purchase a home. Like, there are some certain rules that were put in place, like the stress test, for example, that
Right.
I understand why those rules are put in place, but it is certainly significantly harder now more than ever
Disheartening.
to become a homeowner, if
Right.
that's something that's on your list. So just all these things stacked up against you, but that's why you really kind of want to do your best to be your own advocate and be your own CFO, as I always say, and like working with professionals who do genuinely have your best interests and are bound by their fiduciary duty, which is something definitely to look out for. Um, and so, like, for example, if you are someone that comes to me and you're looking to get pre approved for a mortgage, or um, get me to take a look at what's going on. I may say, you're not ready right now to become a homeowner, but I can be like, these are the steps that you need to take to get there. Or like, if you're going to James to talk about investing, he will help guide you in that regard as well. So it's like making sure that even if you feel like you aren't in a great place, that's the most important time to reach out to
Agreed.
your professionals to help you with that.
Absolutely. So many
Yeah.
times I hear people say, I'm chatting with them or something like that, and they're saying like, "Oh, I'll invest with you once I have money," and it's like, well, I'm not going to say otherwise just so you will invest with me, but at the same time, you need to understand, like my whole philosophy for my clients and myself and anybody really is, I want everybody to make a well informed decision, no matter what it is. I want you to know your options, and part of that aligns with why I got into the independent space, so then I could be, I wouldn't be bound to one company or one product or, et cetera. But I want people to make a well-informed decision, and we're going to lay everything out for you. So then you can make that decision. And I often say I'm an advisor. I'm not a salesperson. So my goal is to advise you, once I have the data, I'll advise on your situation, which I can like legally do because of my courses and my licenses and credentials. And at that point, the ball is in your court. You can lead a horse to water. You can't get it to drink. I am going
Yeah.
to highlight the value, of course, and saying like, this would benefit you in the event of, worst case scenario, or at least with your hopes and goals of home ownership and investing for that, etc. But at the end of the day, I don't make that decision. The consumer, the client makes that decision. And so it's nice when you have somebody that will trust you and like move forward with that. But again, to your point of though, yeah, people should come to us when, like, if they think they have it all together, great. We'll give you a second opinion. If you don't think you have it all together, well, then just come to us to begin with, really. So it's
Yeah, yeah.
the best time. It's the best time.
When you don't have it all together, that's when you going to the experts or the professionals is when they can help you. Not saying that we can't help those who have it all together, but
Yeah,
it's like at that time when you're maybe feeling your most vulnerable, that's when that's when the actions that you take or don't take are going to be like extremely impactful,
yeah,
to for your future, but also your present as well. And um, also, you just don't know what you don't know, and maybe there are things we may find, or like scenarios that we can see that you don't, that can really be beneficial for you as well. So,
right.
yeah, definitely working off of being your own advocate, and you don't know what you don't know. I kind of want to segue that into a recent CBC Marketplace
Mm,
hidden camera video that was released about how the big banks are upselling you. I do want to preface this by like saying, I know not every single advisor at a big bank is out to get you, and there are good and bad absolutely in every industry. um but again, like when we think of the banks, especially when I think of when I was younger and not as not as financially educated. When you think of the banks, you assume financial education, and you assume that's the go-to if you want to learn more about your money, how to manage it, investing it, all that sort of thing. And I remember my first time going into um, a big bank that I was with, wanting my genuine intent was to learn about investing, because I had heard about it. I just wasn't really sure how all of it worked, and that was kind of like the whole point of me going there. And you, first of all, I just hated that I had to go in person. That's just me.
Yeah.
So I went in person, and the advisor like sat me down for an appointment and started going through these different mutual funds with me. But I kept asking, but like, how does it work? Like, how did you come up with this return? Like, how, like, what's in these different mutual funds? Like, how does investing work? And it was just like, oh, let's sign you up, like, let's like move this much into from your account every single month, and let's kind of like move this along. And I'm like, well, I do kind of really want to learn more about this. And it was more of like, they took it as me just, oh, but okay, I guess you want to do direct investing, so we'll just open up a direct investing account for you. And I'm like, no, but I don't want to do that if I don't know what I'm doing.
Yeah.
So that kind of left not the greatest taste in my mouth. And I don't know if you want to have anything to add to that, just from your own experience. I know you like obviously had you always put your clients first, but it might be also interesting your own experience being at the credit union before.
Yeah, it was. There was definitely a lot that I loved about my time at the credit union. So much that I learned. I think back, like if I was to go independent from the get go, and I didn't have like the experience that I already have under my belt of like 3 years of advising experience at a credit union, because if it was anything from like transferring pensions and all the paperwork and all these different things, little things, like you don't it would take me so long to have that same level of experience. So there was a lot of really good things that I learned at the credit union. Some of the things I didn't love, though, sales pressures are very much apparent.
Oh, we're gonna get into that in the next video. Yep.
Exactly. And so there was, like when this, and we'll chat about this or watch this a little bit of the CBC Marketplace video. And honestly, they did a fantastic job of illustrating it. And it wasn't like from a bias, like, oh, all the big banks are bad. Like they just said, this is what it is. We're just showing you. And honestly, the credit unions are the exact same. When I was at the credit union, a lot of people would talk about, oh, I'm so thankful I work at the credit union because it's so different than the big bank. And now I can't speak for somebody that's worked at a bank because I never have. Like I worked at a credit union, which offers banking and the same services. And they say they act on a more local scale, which they do, but to an extent. And they're just, when I saw the video on the CBC Marketplace, when they posted that, comparing that to my time at the credit union, carbon copy, exactly.
Wow.
And so
Yeah.
that was really, it was reassuring for me because I was thinking, man, like if I'm always hearing, the credit union is not as salesy as the banks, I was like, it's already really salesy here. I can't imagine it getting worse than that. But it wasn't worse. It was honestly just the same. And they just kind of wrapped it in a different package and saying, oh, we're different. And it's like, well, member owned versus, corporately owned and a publicly traded company. Yeah, slightly different. But other than that, all the same. So.
All right. Well, let's get into the video here.
An independent certified financial planner and a former bank employee. What is the goal of the bank employee?
It's to sell the products on the shelf and to make you feel good about having purchased them.
So it's just about sales.
Yeah.
At RBC, our tester goes in to deposit $100, but then
you have a credit card limit increase for $8,000. That's cool.
Okay.
And that's not all.
Wow.
And then you have another one for an upgrade to the Ion Plus visa.
So the harm is that you are treating a moment where somebody assumes they're getting a service as an opportunity to slide in there with a sale.
Yeah.
And I think that's kind of gross.
If people have access to credit, how likely are they to use it?
You might not realize how much this is a dangerous thing to have.
Yeah.
It can add up really fast.
No pitch when we visit CIBC, but a different story at BMO. After our tester deposits her cash, she's pitched a checking account.
There is no cost for that. So the only condition for the premium plan to have is maintain 6,000 inside the same account.
I'm sorry, the $6,000 minimum.
I
I can't.
Because then so much, then it's like the same as if you go below zero, because 6,000 is your new zero, and so like if you have to use that money, but you're not using it because you're like, oh, I can't pay my fee. I can't pay my fee. It's like, well, you're just locked up then.
Literally. Yeah.
And if she doesn't maintain $6,000, her account fees double.
There was a lot of sales pressure in every aspect of the bank.
That push to upsell is something this former BMO teller knows all too well.
A lot of people can't keep that balance above 6,000, so they're eventually charged for the premium plan.
The 30
Of course,
bucks?
yeah.
Yes, I've seen it a lot.
We're concealing his identity and someone else is reading his words because he still works in the financial industry and fears speaking out will cost him his job.
Every week, they would release your results and display your name with what you sold.
Why do you think that email went out?
To shame you, you were scared to lose your job.
We obtain internal documents that show the sales credits
True, though.
BMO employees get for selling things like checking accounts, credit cards, and lines of credit. The more money the bank makes, the more credits the employee earns.
I felt like I had to mislead customers in getting products that they didn't need.
That like does not feel good, I'm sure, you know.
Knowing
And
that you're leading them, like you
Yeah.
are doing them a service.
And you can only offer also the products that your bank has,
Yeah.
even if it may not be the best option or suit your particular customer or client like the best. So like,
Yeah.
yeah.
Compromise
And they're
on-
afraid of losing their job too if they don't do it,
It's their
you
li- it's
know?
their livelihood. Like I get that. You
Yeah.
don't want to lose that, but where do you draw the line? And for some of
Totally.
us, it's easier to draw that line and hold to it. For me, I was okay with that if it meant my job was on the line. But I don't have kids. I don't have a mortgage. I have less,
Yeah.
risks if I was to say, not comply, if you will. Not everybody is in that situation, and so that's where it's really tough. It's all I can say. It's really tough.
I remember overdraft being added to my account without me asking for it or like being told. It was just added randomly one day. And especially if you're someone going in there where you already have a hard time managing like high interest debt like credit cards or a line of credit, and you're being told you're eligible for this and you're eligible for that, and your limit can increase. Like I get why accepting like a pre-approved limit increase could be enticing for people because it could help lower your credit utilization. If you're someone that is more responsible and you consistently pay your cards in full and on time, that's great, but
Sure.
not everyone is like that. So to offer that to people who are vulnerable is pretty predatory, I gotta say.
It is.
Yeah.
It is. There's no other way around it. It is predatorial, and it's
Yeah.
the big banks don't make like sure they can make a lot of money on like management fees on investments from like wealthy people, but they're making most of their money from the person that's within $200 of not being able to pay their bills because
Mhm.
overdraft, and then they got an NSF fee for $50 or whatever they're charging. And I can't remember if this was in the United States or if it was in Canada, but during 2020, like the start of COVID, the banks made like $8 billion on NSF fees alone. And I think
Wow.
that was the United States. But the quotes are like the numbers are out there somewhere. And just to think like that was when people were losing their jobs and everything like that, and banks weren't waiving those charges. They probably shouldn't have the
Mhm.
charges to begin with, but they're like,
Mhm.
oh, that's how we make money. And it's
They're at the end of the day, they're publicly traded, profitable businesses, and that's profits are number one.
Profits are number one, and that's why they have these pressures. It comes from the top down.
It was a very unethical thing to do, and I felt like I'm putting them in a worse position.
And what's worse, he says colleagues added products to customers' accounts without
And
their
that's
knowledge.
that's illegal.
Many times.
You can't
Yeah.
do
because they needed to meet their sales targets.
Sound familiar?
Sign up customers or face being fired.
7 years ago, my investigation with CBC's Go Public team revealed the immense pressure employees at all the banks were under to sell.
Already there are calls to better regulate financial titles.
Selling products and
Financial
services
titles is a big
people
one.
didn't need just to hit targets. Sometimes even breaking the law, doing things like increasing credit card limits without permission.
It's hard to trust them after seeing incidents like this.
So, has anything changed?
Nothing has changed.
No.
At TD, as our tester is depositing her money,
You've been such a good client with us, you're able to get a credit.
You've been such a great client with us. I love how the person starts with that.
We don't have to look at your
So you
income.
qualify for a
Yeah.
credit card. You don't even need an income check.
The ideal situation is for a credit card to be given to somebody who then keeps a balance
Yeah.
on it. and
For
can't
them,
pay it
yeah.
off. But of course the bank wants to sell people credit cards, and of course the barrier to entry is going to be so low it's in the floor.
Yeah.
nothing at Scotiabank. But over at another BMO branch,
It's just that you're qualified to get a pre-approved personal line of credit.
our tester is told she's eligible for a $25,000 line of credit.
You would recommend that?
Yeah, I mean, it's not all the client will have this kind of offer.
A line of credit with a slightly lower interest rate can really amplify the small amounts of
small
overspending
amounts, yeah.
that add up over time, and suddenly you have something that's incredibly difficult to pay off.
Our hidden camera findings, not surprising to this former BMO employee. He recently quit when the pressure to sell became too much.
I said, I feel like this is wrong.
And what did she say, your manager?
She says, every bank does the same thing. If we do it, at least we get the sales.
And it isn't just the frontline tellers.
If you sold, $500,000 mortgage, it would be worth 500,000 points.
This former Scotiabank senior financial advisor says he was pressured to sell too. We're concealing his identity and someone else is reading his words.
It's not a customer service or advice-driven environment. We're there to sell and make money for the bank.
They don't get paid for advice. They get paid on stuff they sell.
Yeah.
With the stakes higher.
The fact that stuff gets added on without your consent, that's really disturbing. Yeah. And you said it's illegal.
Well, it is illegal. I mean, if somebody adds a savings account to your account and you didn't pay, you didn't ask for that, I'm sure that's like breaking some sort of rules. But when it comes to lending, overdraft is seen as a lending product because it's like a very, very, very short term flexible loan you can dip in and out of kind of thing. It's got an interest rate attached to it, and you may not have to necessarily qualify for it, but you do need to have a credit check done and everything like that. You can't get away without a credit check being done for a lending product, because if you're in bankruptcy, they can't lend to you or something like that. Any time I did any sort of lending at the credit union, lines of credit, loans, mortgages, anything, you have to sign for it. There was no possibility that you could not sign for it. So to think that people were doing that without that happening and being given these products.
Yeah. And again, it's for some people, being pre-approved for a line of credit, for example, might be great for them. Maybe there is somebody that is genuinely wanting to transfer their credit card balance to a lower interest line of credit to, pay less interest over time, and they have a solid plan. But for those that don't, that's just a recipe for complete disaster where you're going to end up owing on both the line of credit and the credit card, and now you're in an even darker place. So you have to go in there if you are gonna meet with advisors at the bank. You need to go in there knowing what products they have or what product you need, and be able to really best explain your situation and why you want something, as opposed to relying on them to always be the one to give you the best advice, because obviously that's just not the case.
You have to be a little skeptical naturally. And I think it's good.
Yeah. You got to ask why they're recommending this to you. What's in it for them? Yeah.
Exactly.
Better?
So Sandy, your head was literally in your hands.
Oh, it's so bad.
We're back inside the banks after this. Sales culture inside Canada's big banks. Visiting branches to hear the sales pitch. Hidden cameras rolling.
Even if you're fine with us, you're able to get a credit card with us. Oh.
We're
Like a
also
carbon
speaking to
copy.
current and former employees
Oh, for
about
sure.
the pressure to meet high sales targets.
You have to sell something to that customer, even though they don't need it.
Pricey products you don't need at a time when costs are adding up.
Are you feeling the pinch?
Absolutely.
It's an extra, $100 to $200 a week that we're looking at for a family of 4. So
At the grocery store.
yeah, at the grocery stores.
My mortgage rates are constantly going up, and for my husband and I, it's just so hard for us to make those payments.
I've had quite a few clients cry and, tell me about their hardship.
Tough financial times.
definitely
What
some
this
tough conversations
TD
that have been had
employee is
before.
hearing more and
Remember
more.
yourself being a part
We're
of those.
concealing
It's
her
tough.
identity and using a different voice.
It feels awful. I shouldn't have to think more about my target than the client's well-being and their interests.
Yeah.
She says she's got a
Bottom
huge
line.
target to sell investments, even as some clients say they have bills to pay.
I have had an increase of clients upset, having to take money out of their children's RESPs. If they need to take money out, we have to do what we can to sort of
Yeah, you
stop
can't,
it.
you can't stop
So
it too. It's their
to be
money.
clear, do you feel
Nor
you're
should you,
under
though.
pressure to get customers to make financial decisions that may not be in their best interest?
100%.
And she says there's proof. She secretly recorded a coaching session with her manager about pushing customers. Her words are read by someone else to protect the insider's identity.
When I hear you talking to them, it's almost like you think of them a lot. So that's why you don't want to put force on them. Because you're thinking about them, it kind of backfires for you in meeting your goal.
That's crazy. That's
I don't
absolutely
think
crazy.
it's backfiring. I think I'm actually
Terrible.
helping the customer. It's upsetting
Yeah.
because this is the corporation I work for, and this is all driven by greed.
Seems like we need to do more digging. So we're heading back inside the banks, this time to test what kind of financial advice we get from
I love the
folks
hidden
beyond
cameras.
the tellers.
I know.
Let's hook
They're
up
so
this one
good.
to your button cam.
Those trusted financial advisors and planners.
There we go. It's now recording.
Helping us out,
I've had
our
to
put it in
colleague
a
Kimberly.
coffee
She's
cup.
going
Oh, wow.
undercover.
If they
I don't
ask you
remember
have
seeing
some
that part.
debt, credit card debt, about $17,000.
Telling advisors she wants to
Right,
invest
I
a
remember that.
$50,000
Yeah, when I heard it, like,
inheritance.
watch this
Yeah.
True,
talked about like
but
coming in
they're
with an
testing the
inheritance
advice
and all
we
that.
get. First up, what do the advisors tell us to do about that credit card debt?
Hello. I'm just wondering if there's an advisor that I can meet with.
At Scotiabank,
This would
You
be
don't have to pay out all of it, but definitely pay out a portion.
yep, just pay
Oh.
off a portion of that debt. Invest the rest.
Uh-huh.
Bad advice, says certified financial planner Sandy Martin.
There is no way that you can make
Yeah.
19.99% on your
Yeah.
investment. It just won't happen. Of course, you should pay your credit card debt off.
The advisor does not get paid to pay off the debt.
You don't get any sales points.
No, I don't get any points for that.
Over at TD,
You can do a minimum payment.
minimum payment?
God.
Minimum payment.
At RBC,
Wow.
this advisor also tells us to just pay off some.
For example, 7,000 or 10,000.
Or she suggests taking out a line of credit to pay it off.
Taking
I
out a
personally do not think line of credit
debt.
as a
You're just
borrowing
debt.
thing.
Trading debt for debt.
Yeah.
Encouraging somebody to only pay off a little bit of their debt and then move it around to get a little bit less.
You're just
like a
moving it
lower
around,
interest rate.
yeah.
That is still bad.
Not getting
advice.
rid of it.
As for that inheritance, all the advisors recommend investing in mutual funds that earn them sales credits. They're not allowed to guarantee the returns
Right.
on those
Yeah,
investments.
returns can't be
So will
guaranteed.
they? At CIBC, seems
Oh,
like it's
Lord.
a sure thing.
The average interest you will get at least
At least 10%.
Wow.
Absolutely more than 10%. That is
Wow.
why I'm saying keep it there.
Absolutely.
He's
Yes.
guaranteeing
Yeah, you can't
absolutely
guarantee
more than
that.
10%. Can he do that?
No. Oh, no. He absolutely unequivocally cannot guarantee any number from a
Yeah,
mutual
any
fund.
number. You can't even
And
guarantee
there's
1%,
more.
even if it's an equity
Financial
fund. It
advisors
is,
tell us they
since
felt they
inception
had to
performs at
sometimes
double
cross
digits.
the line
Can't
just
guarantee
to
it.
sell those investments.
It's not a term
The
deposit. It's not a
TD
GIC.
insider
It's not a
reported
bond.
another manager telling her to snoop around a client's accounts. His words are read by someone else.
See if the client has got cash sitting somewhere. Because if you don't profile, that's where the big money is.
That was
Big
something we were
money
told
that
to do
could go
all the
toward
time
a
at the credit
product
union.
the bank
Really? Like profiling?
Yeah, we would go into our software and you'd pull a report and then you could filter to see who has the most cash sitting in their, like just cash for example, sitting in like their TFSA, RSP, checking account, savings account, term deposits, because term deposits we would make some money off of. We would lend that money and then pay them a little bit of interest. But if we were to get that money into mutual funds, of course, that's where we would make even more money. So there was always an incentive to put it into an investment. But then they're like, oh, but make sure that they have, make sure it's good advice you're giving them. And it's like, well, good advice would probably be keep it where it is. They probably need that money.
Yeah.
5-10 years, until they need that money. They're saving for a car or something, and they're ready to buy it in like a few months. It's like, you don't put that in the market, right? So yeah, but yes, there's a lot of not incentives, but a lot of pressure to sell. It's just so we don't get fired.
To meet that sales quota or the target that is set for you, that's astronomically high.
Yeah, very high too.
Wants to sell. TD tells us the recorded conversations are completely unacceptable and do not meet their code of conduct.
This behavior.
As for the former Scotiabank advisor, his breaking point, the death of a client's husband.
I mentioned this to my direct supervisor. The first question he asked me was, are we still getting their investments?
Wow. That was the first thing he cared about.
That's when it really hit me that there's no compassion at all. It's all about the numbers.
How do those numbers play out when it comes to investments? Back on Hidden Camera, we're asking about the fees charged on those mutual funds. They're important because a typical fee of 2.5% could eat up almost half the value of your
you will pretty much always pay a fee,
25 years.
unless you're trading stocks on your
final
own.
Check.
Like
What will advisors
fees
who
are
have to sell
you're going to have
mutual
them
funds
regardless,
to hit targets
but
tell us about the fees?
Painting the picture.
At
But
BMO.
can they explain them?
Out of your returns.
The advisor incorrectly says the fees are only charged on any profit that $50,000 inheritance earns, not the nest egg itself.
Just the returns. So if the return was $5,000, it wouldn't be the $55,000 that they take it off.
No.
They take it off the $55,000.
At TD, we're told not to worry about the fees.
A lot of clients won't even notice because it's very insignificant.
We're also told incorrectly they're only charged on any profit.
Will that 1.9% also be taken from the 50,000? Or
no, it's not taken out from your own principal.
RBC gets it right.
They don't even know
the
their own
apply to the
product.
whole investment.
And
but
I hate to say it, and I obviously would not say any names or
this.
anything, but that was what we were encouraged to say too. And so when I was looking at, like, I was like scratching my head. I'm like, how is this person, if they're paying like 2.2% management fee on a mutual fund? A lot of the fees were even higher than that because our proprietary product was higher fees and everything, which again, limited product shelf, not a benefit of working with somebody with a limited product shelf. You want to have flexibility, but in seeing those, those fees, like they were saying, oh, it's just tell them it's a fee from, like that's just on their returns. So if they make $100, they'll be charged 2% of that. So like $2. And it's like, well, no. And then I remember I looked and I Googled, I spent some time because I was like Googling, like, how is an MER, management expense, charged? And RBC had this really good illustration, which like credit to RBC for this, where it showed like this like pie chart, and it said like, what the fee is, where it goes. So it pays for the administrative, it pays for the advice, it pays for everything like that you're getting. And the investment management, of course, but it said if you have like $100,000 and you're having a 2% fee, let's say, that's $2,000 that you're paying. And so when I was hearing people say this at the credit union, that it's on the profits, I'm like, well, you haven't had any profits yet if you invested $100,000. So why are you paying $2,000? Now, of course, that's over the whole year. That's how it's calculated. But yeah, I was like, this is directly contradicting it. Like you're actually paying a fee on the profits and your principal. And as your money compounds and grows, your fees get bigger. So that's where usually when you have higher dollar amounts, companies will charge you less of a percentage of a fee because they're making more money from you. But not all of them will do that. And the banks are, they like to keep as much money in their pocket as they can, unfortunately. And the credit unions, it's just how the banking world works.
Yeah. That's crazy. And it's interesting that either they aren't aware of how the MER is calculated or what is it's taken off from, or they are just providing inaccurate information like on
Very
purpose.
inaccurate. It's just blatantly, it's just straight up wrong. Like
Yeah.
it's not true. So pretty
Yeah.
crazy.
Return. You
Right.
don't have to worry about
I
the fees.
see. Okay.
As long
At
as you're happy with the
Scotia,
return.
the
you don't have
advisor
to pay
claims
fees.
he doesn't know how the fees work.
I heard they only take it out of the
Oh
gains.
Lord.
So let's say if you're
Not
50,000
he
goes
heard.
to 55,000,
Yeah.
that 5,000 gain extension, that's where they take the 2% out of. I'm not too sure how they calculate it.
So, Sandy, your
I'm not too
head
sure how
was
they calculate
literally
it.
in
Come
your
on.
hands.
Oh, it's so bad. And I genuinely believe that those frontline advisors don't know the answer. They are
They're
guessing.
licensed mutual fund dealers.
Oh, that bar is so low.
All told, only one advisor gives clear and correct info on mutual
one.
fund fees.
Wow.
Do you think the pressure to sell products was behind some of the advice we got?
Almost all of the advice that you got, I think, was influenced very heavily by the pressure to sell financial products.
For sure.
Hey, Duff, Erica Johnson with CBC.
Duff Conacher is a consumer advocate who's kept an eye on the banks for decades. His take on what we've seen?
They're not only getting bad advice, they're getting illegal advice.
Yeah.
He's talking about clauses in the Bank Act that require banks to not take advantage of customers and offer appropriate products and services.
Yeah, it's
So
law.
what we
It's legal.
documented, you say, is
Like-
breaking the law.
Yes.
Code of conduct.
Yeah, I think very clearly the advice that was given violates the duty in the Bank Act for the banks to act in the financial interests of their customers.
All 5 banks declined our request for an interview, pointed
right.
us to the Canadian
Surprise,
Bankers
why?
Association. In a statement, it says our findings do not reflect the experience millions of Canadians have every day.
But it does.
Oh, it absolutely does.
They add that a more
100%.
formal analysis of the client's needs is expected to be performed
This,
when
yeah,
moving
this
from
this
an initial
CBC
conversation
Marketplace video
to
was very well
establishing an
done
investment.
because I can speak from my experience only, and that is
Mhm.
my experience. This whole video painted is some things were slightly different, but very much like 95% of this video was the same as my experience. So that just goes to show, like, it's if you're seeing that at one bank and then you go to the next bank and they do the same thing, and the next bank and they do the same thing, like there's a trend. It's not to say the track record, like history is going to repeat itself, but it like all these banks are doing the same thing. So yes, they are repeating one another because they have the same business model.
Yeah.
Same with credit unions. They're all the same. They're just, yeah, credit unions, they're not publicly traded, so it's a little different. They don't have, like, shareholders to report to them. The shareholder is the member, the person that owns the bank account. But in order for the company to make more profits, because they're not publicly traded, they have to make lots of sales.
Mm-hmm. What are some of the things then would you recommend that people look out for when they're wanting to work with an advisor, whether it's investments or insurance? Like, what are questions that you would recommend they ask?
First, I would just be cautious of kind of like quick advice. I don't necessarily I don't necessarily think it's always a bad thing, because sometimes it's a very simple scenario, but like 19, 20 years old and they want to start saving for retirement, and that's like their main goal, let's say. Well, then, yeah, like set them up with, if depending on their income, maybe they could use an RSP, TFSA, combination of the two and all that. So like there's certain situations that are more simple than others, where it's like, yeah, we could get this done in like a meeting and like it seems all good, all that, right? There's other times where it's more like there's more planning involved, there's more advice that needs, like, more data needs to be gathered, and some people are like, oh, let's just throw you in a mutual fund, and it's like, well, no, like you don't know, like, what if that person has like zero risk tolerance and they're super risk adverse? Like, well, then you should put them in something guaranteed. Sure, it's not going to yield as good of a return or likelihood, but you got to do what's right at the end of the day. Like, be cautious of like those quick advice or like quick like recommendations. Not to say they're always going to be wrong, but just take them with a grain of salt. When a product is being recommended to you when the person knows very little, so again, quick recommendation thing, just be skeptical. I think it's good to be skeptical. I don't think it's good to be constantly skeptical, but have a sense of like, okay, like, you can't trust everybody and what everybody says, no matter what. Unfortunately, we live in a flawed world, so you have to watch your back. And just because this you bank somewhere doesn't mean that they're going to do everything. Like if you bank at RBC, TD, wherever, fill in the blank, doesn't mean that, but they've got my back. That's my bank. No, their back is their shareholders. That's who they're looking out for. They don't care about you. They just want to know, okay, how much money are we making off of you? If we're not making enough, we're either going to not spend a lot of time on you, or we're going to try and spend more time on you to get sales out of you.
Preach.
So that's just how it goes.
What are some things that you feel like young Canadians can do to protect themselves and their families? You kind of mentioned, like, having a little bit of skepticism when you're being presented products, or like any common mistakes that in general you may notice from clients or from people you've worked with before, common mistakes to avoid or misconceptions they may have.
Yeah, great question. A lot of things that could be said. I think like understanding debt is very important. Me personally, like I'm an advisor. I've been doing this for almost 4 years, and in my time as an advisor, when I was at the credit union, when I was an employee, I got a credit card. I applied for it, of course, and everything. And I got like a $15,000 credit card, and I was like, this is such a big limit. I don't need this, so I halved it, because I was thinking, it'd be good to have a little bit of wiggle room for, my ratios and keeping my credit score all right in case I carried a bit of a balance. But having that big of a credit limit, it was not justified. And I ended up just little purchases just got like stacked up and up and up. And then eventually, like I had a decent balance that I had to pay off. Luckily it's paid off and everything's good there. But that's something that when the CFP, the certified financial planner in the CBC video was saying, like, the line of credit, lower interest rate. Yeah. But that can stack up on you with those little extra purchases. I can speak to that. And that's coming from somebody that's an advisor. People think I know everything, and I know what to do and what not to do. In that sense, I know I shouldn't have done that. But when you have access to it, it's very, very easy to dip into it. So my recommendation would just be careful with how much debt you have. Like, you want to make sure that you have enough, like, say, credit card limit in case of an emergency, but not so you could just go crazy and shopping spree and go to the mall with your friends and put everything on your tab. That's not what it's for. I've spoken in some high schools recently on financial literacy, and something I always say to the students, because a lot of them are like anywhere from grade 10 to grade 12. So they're entering the real world, let's say. And I say to them, if you have $500 in your bank account and you get approved for a credit card of $1,000 and you want to go shopping, how much could you spend? Or I say, how much should you spend, or could you spend up to? And some of them scratch their head and they're like, well, I have $1,000 that I could spend on my credit card. It's like, well, but how much do you have in which you could pay for it in cash? They're like, oh, well, $500. It's like, so I always say, treat your credit card like a debit card. Treat it as if it's linked to your bank account. If you have $500 to your name, you should not, you probably shouldn't spend all $500, but if you were going to, don't spend more than that. So being cautious of the debt, and being approved for all these different things. Like, if you have really, really good money practices or practices with money and managing money, and you're not like an impulsive person, then I think it could be good if you have like potentially some extra debt availability on hand. But that's a small percentage of people. As for somebody that's more impulsive, not a good move. There was times at the credit union where people would, they're like, I want to invest. I need to start investing or something along those lines. Maybe they have a little bit of money to put in already, like $10,000 or something. And then a month later, they're like, oh, my money's down a little bit. Like, what's going on? It's like, that's just how the market works. It goes up over time. Like it always has, but it will have hills and valleys between then. If you zoom in, if you pan out, it's like not a steady uphill, but it's like up a little bit of taper off, and then it crawls upwards. It's not a sprint up. And a lot of people, they would answer like this personal investment questionnaire and like to gauge their risk tolerance. So like, I remember one of the questions at the credit union was, if your investment went down 25% in value in like a 3-month period, what would you do? And so you have options like sell it all, sell some, stay invested, keep more in. And that's where it really just depends. If you're somebody that's like about to, like, say you're trying to get pre-approved for a mortgage, like you're of course, that's what you do. Like you, Farah, that's what you do. And if somebody's coming to you and saying, hey, this is the down payment I plan on having. Maybe it's like 80 grand, 100 grand. And if they're invested in like a very high, like just all stock portfolio, that's going to fluctuate a whole lot. And so a lot of people, they may think, oh, I should stay invested in that. But that's probably a time where you want to be in something less risky because you need that money in the short term. If it's something retirement wise, like I've met with people and they're like, oh, I'm super, super conservative investor. And like, that's totally fine. There's nothing wrong with that. It's whatever allows you to sleep at night knowing that you're invested
That's the
the
major
right
key.
way for you.
Yeah.
Right. And so there's times though. So like some people, they'll score like a 4 out of 10 on the risk assessment. I'm like, okay, but how long do you have? Like, I kind of want to like pick their brain a little bit. I'm like, okay, so how old are you right now? And they're like, oh, I'm 30, let's say. And then I'm like, okay, and you plan on retiring when you're 65, maybe? And, we've gone through a conversation. They're like, yeah, 65. I was like, so you have like 35 years. Well, you may not even start withdrawing your money until not even 65. It might be age 70. And so you have such a long time horizon that you could afford to take on some more risk, at least in these early years. So that's where it's not a cookie cutter solution. Some people are very much like, I just want big returns. Who doesn't want big returns? But you also have to make sure that you're adequately, your risk appetite is, or your portfolio is in line with your risk appetite. And for me, I'm a more riskier investor. I like to pick my stocks myself. I like to do some mutual fund investing, but that's because I know that this is what I do. I'm the expert. I do this for a living. I understand how the market works. I'm not worried if my money goes down like 50% next month, because I know that the way it's invested or how it's invested, it's likely going to perform much better than anything else in the long run, broadly speaking. But that's because I can't expect everybody to be, to my knowledge level, let's say, of the markets, or understand how market cycles work and everything, because they don't do this for a living. So that's where it's like, when we talk about like the CBC Marketplace thing and the education, like, and you were talking earlier, you want to be educated. And like a lot of people, I've learned this, and I'm still learning this, is like some people just want to know when they invest with an advisor, they use an advisor, like, is this going to help me? Yes or no? If it is, yes. And that's like, if you really boil it down. But a lot of other people are like, I want to understand how this works. I want to see, whatever. And it's like, that's where you got to, you can't just like place somebody into something and assume it's good for them. You have to go through all these hoops. And people try to like duck around the hoop and they try to avoid it. It's like, no, you can't do that. But then the banks, like we were saying earlier, they don't get paid on advice. They get paid on what they manage. They sell products. That pays for the advice, that pays the advisor's salary. So then you can say, oh, well, like they're not compromising on their morals because they don't get a commission from this. They're on salary. While that is true, your salary is propped up by the products you sell. And if you don't sell products, they're not going to keep you around. They're going to say, hey, there's the door. You're not making us any money. So there's that to be said too. And it really sucks. Like a lot of people think, oh, it's job security, it's safety in the banking industry. There's a lot of turnover. And that was another reason why I left, because I wanted to be my own boss. I always wanted to do that. But now I'm like, okay, I don't have to worry about somebody telling me what to sell or how much to sell of this. I get to do it however I see as fit, which is to do it the right way. If that means I don't make money and I provide a recommendation, hey, at least I can sleep at night knowing that I did my job correctly and I did a service to the client. Yeah, I'm not going to maybe make as much money as somebody in like I'm still in a commission role. And I won't maybe make as much money as somebody doing like sleazy sales, but I'm in it for the long game. I'm not trying to like cheat my way to the top, because there's a saying, it's like cheaters get to the top fast and then they get back to the bottom even faster. And that's not how I go about my business. That's my reputation on the line. That's everything. So
yeah, no doubt. I kind of want to get into like financial offense versus financial defense, because the income, the investing, that's like the sexy side of finance. That's what everybody wants to talk about. That's what everyone wants to know about. And I get it. But then, there's also the financial defensive side that I think is just as important, but I feel like is often neglected or just isn't discussed as often because it's not as glamorous or sexy. It's the insurance side of things. So
Yeah.
I'm talking things like critical illness, disability, life insurance, mortgage insurance, all of that good stuff. And I'm just curious, like in your own line of work, like how you go about helping clients determine what sort of insurance products work best for them.
Yeah.
And then also like a high level, just kind of what like age group, even, if we're talking young Canadians, like some of the things that maybe that might pertain to them more significantly when it comes to insurance.
Yeah. One thing I would say is it's actually something my personal trainer said to me years ago, and it was something I've applied to kind of like this approach of like making sure you have the right stuff in places. The saying that he gave me is like, don't prepare the plan, prepare the man. So planning is, it's good to have a plan, but if you don't prepare yourself for the inevitable or the what ifs or the hiccups in the road and all that stuff, then what good is your plan if it just, a lot of people plan like things to go like uphill, like correct, and just, they plan for things to go well, but they're not always going to go well. So you have to, like, you can't say like, oh yeah, when I'm 50 and I think I'll have a heart attack. It's like, well, you can't plan like that way too, but you just have to plan, okay, things aren't always going to go my way at any given time. You gotta take that as they come. And that's where insurance can be a really big help, because that's how you're preparing yourself for and really solid proofing your plan, your financial plan. So for example, if I don't know if you've heard this before, but a lot of people, like I often say, like when I ask people, I say, what's your biggest asset? And so a lot of people think, oh, my house, my car. It's like, your income is your biggest asset. Your income is what allows you to pay for a mortgage, for rent, for food, for your family, functioning in terms of like all the expenses and everything like that. So if you don't have insurance for, like, say, yourself, in some sense, if that's, you pass away prematurely or maybe even at any point, because there is like permanent insurance and other ways to do that, where you're leaving something behind for them. Maybe it just covers like the tax bill on your estate. Maybe it gives them like an inheritance or something, or pays off the mortgage. Like, you want the scenario to be better, like when you leave it. You don't want it to be like
Even worse.
Exactly. So little things like a lot of companies in the group benefits package will provide some sort of insurance coverage. And I don't mean like dental insurance. I mean like something like a disability, for example. And that's actually something that's quite common in these plans. And disability can be sometimes hard to qualify for, because the way insurance companies see it is that if you qualify for this product and you file a claim, so let's say you're like 30 years old and you have a disability policy, and then you get into some sort of accident and you're permanently disabled, they could be paying you like whatever that monthly benefit is, which is tax-free to you as well, which is great, to potentially age 65. So they're going to be on the hook for like hundreds of thousands of dollars. So they make it tougher to qualify for that. So they make sure like there's a job called an actuary, and an actuary is a person that assesses the risks and the premiums and what they should be charging and all that. So those people work at these insurance companies. But you should have, like, if you're a self-employed person, you should look at having disability insurance. If you're the breadwinner in the family, you should look at having disability insurance, because think of it as, if I'm sidelined for a period of time, the average disability is about like period of when somebody's on disability is about 36 months. So about 3 years. And even if somebody, I even say this, like some people think like, oh, like I've got the savings, I'll be fine. It's like, well, you're going to deplete your savings though. Would you rather finance temporarily for a little bit some insurance costs and then have that cover, you, rather than deplete your savings and start from zero kind of thing? So there's a lot of different ways to structure that. Critical illness is great because if you get diagnosed, there's like 24 to 26 different diseases that qualify for it. Something as simple as like a cancer diagnosis. Once you're diagnosed, you survive 30 days. Even if it's like stage 1 cancer, like a skin cancer, melanoma, it's pretty common. You can get whatever this payout is. A lot of people think like 100 grand is the magic number you should have for critical illness. It depends. Sometimes less you need, sometimes more. Just depends on your living scenario. But that's something where, even if you aren't sidelined, maybe you're going to continue working. At least you can pay for your medical treatments. At least you can pay, or maybe you can, just take time off work. Like maybe you're still able to work, but at least you can give yourself some time to rest and relax and make a full recovery, because stress does contribute to cancer cells being produced. It's true. My mom had breast cancer. And her whole thing, like, we deal with a naturopathic doctor. The doctor said, you need to be in the least stressful environment as possible. So having something like a critical illness allows you to de-stress. Yes, it sucks to have a critical illness, but at least you don't have to worry about the financial part that, financial sucky stuff that incurs when you're on disability or critical illness takes place and all that. So it's very important. I don't think that everybody needs it. I don't believe that everybody needs it. If you're 19 years old and some guy at a multi-level marketing insurance company, I won't say which one, but let's say they are like, hey, you need this insurance policy. I would question that if they actually need that, especially if it's permanent insurance. But there are some times where, if you're young and you are looking for something just to, it's going to be the younger you are, the cheaper your insurance is going to be. So if it to get a certain insurance policy, maybe it's a small disability policy, maybe it's especially if you're self-employed, or critical illness for like, just to cover like medical costs that you may incur. You can have that policy for maybe like 40 years and you'd be paying like $20 a month or less than that. Like that's just a few Starbucks coffees a month. And sometimes, and then you can, even after like 15 years, you can be like, you know what, I'm going to refund all my premiums. And then you basically just had free insurance. So there's a lot of ways to go about it. But it's definitely, I don't believe insurance is for everybody. I think majority of people, yes, in some capacity. But I think you should know your options and you should speak with a professional before you move forward. I don't think anybody should, I wouldn't assess myself for a disease because I'm not a doctor. I would go and see a medical professional for that. Same thing with, I'm not going to diagnose you or recommend something. If, I think like, that's why DIY investing, it can be fine if you know your stuff. If you don't know your stuff and recommending that you do DIY investing, you're not qualified. You should seek a qualified opinion or advice before you move forward. And that's just my personal philosophy. I just think of that in all areas of my life because I see value in that. So
if there's somebody out there who knows more than you, why not seek out their opinion or their advice to help you? Yeah, for sure. Bring more value to you and grow your own knowledge too. So
absolutely.
Yeah, definitely. My last question is the future to you for young Canadians like completely bleak? Is there no hope? Is there a lot of hope? Are we somewhere in the middle? What's your take on that?
I think we're somewhere in the middle.
And it's
And
not so black or white.
Yeah, very. When it comes to housing, like not to get like all political, but the current government has made it really tough for housing to be affordable. And so I know like the Conservatives, for example, have talked about we're going to build way more houses and all that stuff. And until they actually do that, like it's just a thought. So I'd like to see it actually take place. And if it does, I think that would really help. And that would mean more optimism for the future. Because when it comes down to the price of a good or service or a commodity, it comes down to supply and demand. And so if supply is low and demand is high, that's going to create a more expensive product like a house or asset. So we need more houses. If we have more houses, I think it'll be much more I will be much more optimistic of the future for younger Canadians, including myself and ourselves. That's a huge thing. Groceries, for example, have gone up way more than 3%, even month over month, basically speaking. They've gone up tremendously. It's like gas would go up like a lot and then it would come down. And now gas is still a bit expensive, but it's better. But groceries, like I don't know if you saw, it was like a TikTok recently. And it was somebody that they bought something on it was like,
Was it the $100 worth of groceries? Yeah. Oh my God.
Groceries that they bought like 2 years ago, they hit reorder and it was going to say it was like $400. And I'm just thinking like, that is crazy. So if there is metrics in place, which again, big corporations, they don't want to lose money. So that's where I think the government would have to step in and really help. But then again, that's a big cost for the government and that could just fuel inflation too. So it's kind of like, pick your poison.
Yeah.
I am optimistic. I'm more optimistic about housing when it comes to just, like a cheeseburger that costs like $2 today. It's naturally going to go up over time. Everything's going to go up over time. It's just the necessities, I hope, are more affordable than the extracurriculars. So if it comes down to like houses being more affordable and fast food and restaurant dining and all that stuff being more expensive, I'm personally okay with that, because we need roofs over our head. We don't necessarily need to go to McDonald's every single day. So that would be nice to have more of those fixed expenses being more affordable.
Yeah.
So yeah, to summarize, I'm optimistic about the future. I think some people may think I'm being too optimistic, but I do see there's a lot of potential, regardless of what
Yeah.
anybody thinks. There's a lot of potential, but it's just a matter of if that potential gets utilized or if it just gets squandered. And then if the potential that we have to, not necessarily turn things around but make things better isn't used, then I will be more pessimistic for sure.
Yeah.
Because that's kind of the trajectory we're on currently. So it's but I mean, if I could just say, like, to those that are in a position where they're more like not so optimistic and they're really thinking, oh, it's just really bad, focus on what you can control, focus on your spending, save your money as best as you can. I know it's tougher for a lot of people to save money these days because they're cash strapped because of everything going up in terms of their costs and expenses. But do what you can control. Let the policymakers and everything take care of the rest. Hopefully they're good and qualified and competent. That's why we have democracy to vote them in. But I think government's going to have a large play in this. And so I just hope that whoever's in power, I don't care who it is, I just want it to make sense for everybody from a financial perspective. I want it to be so people can, when we talk about fertility, that people can have babies and not have to worry about, can I even start a family? That should be the last thing somebody should worry about. I just think that's really depressing that we're in that state. So yeah, I'm optimistic, but with a bit of, it's not too optimistic, if I can put it that way.
I could definitely agree with that. I think I have a similar sentiment. I've been kind of gauging grocery prices as a whole, obviously myself going grocery shopping, but then I have my little rice cake price meter that, like, I know for the past maybe like 2 years ago or 3 years ago, like, rice cakes were like less than $2 a bag, and now they're like $3 almost. Like, it's like 100% increase in that one
100%
product.
increase.
Yeah,
It's
so
$1, but it's 100% increase.
exactly. So I'm thinking about things like that. And yeah, I'm the same. Like, I'm naturally an optimistic person, but there are things that, with these studies we're discussing, there are findings that are pretty worrisome. And
Very true.
I feel like certain policies put in place maybe have been put in with good intentions, but not necessarily the outcome that is desired from it. I'm talking more specifically about like newer, like first time homebuyer policies, like increasing the RRSP amount that you can pull out, that sort of thing. I mean, FHSA is great, but again, it's $8,000 per year, maximum of 40.
Yeah, it's not a ton.
And then I'm thinking of things like 30-year amortizations for first-time home buyers, but it needs to be a new build. So,
It has to be a new build.
it has to be a new
Oh,
build.
I didn't know that.
So if you're a first-time home buyer buying an already built home, don't get that option of doing 30-year amortizations. Yeah.
Didn't know that.
So, and how many first-time home buyers are buying a new build? Who knows? I'm sure there are folks out there, but I imagine it's not necessarily as many as we would think.
I would agree.
So, like, I feel like the intention is there, and I get what they're trying to do, but it's also like, that incentive doesn't necessarily address the building issue we're having in the country. So it's like, like, we're
Maybe
there, but not there.
Yeah,
Yeah.
I think we're on the right sort of path in a sense,
Ish.
but we're ish, like ish at the moment.
Yeah.
But But yeah, like the thought is there, but it's like, okay, the thought isn't going to make our bills cheaper and make housing more affordable. Action has to be done. Execution has to be done. And that's, it's like, if we just talk about this, like not we as in you and I, but if we as government, as people, whatever, to say like, oh, we need to make some change happen, but nothing happens if we don't execute, well, then there's nothing is going to come from that. So enough like talking. It's good to say like what you're going to do or how things are going to get better, but it's like if you don't take any action, if you say, oh, I'm going to save for this car, I'm going to save for this house, but you just continue buying Starbucks every morning, you're not saving. It's like, how are you doing anything to actually get towards that goal? And that's on a more micro scale, but on a macro scale, like with what governments are doing and all that stuff, we got to make sure that the best people are the people that have our best intentions are in power, because if not, the same old is probably going to repeat. So so I'm optimistic, but I think that I'm typically a glass half full kind of guy. I don't say glass half empty, but it does feel like the glass has been emptied quite consistently, and I'm still I'm hanging on to that optimistic part.
Yeah.
And I do think we can turn it around, but it has to be done very soon.
And I can understand why people are pessimistic right now. I really do. I really, really do. Yeah, it's tough times. It really is. Yeah.
It is. But we keep chugging along. That's all we can do.
Control what you can control.
That's right. Very true.
Can you let the listeners or viewers know where they can find you if they want to work with you, interact with you, that sort of thing?
Absolutely. Yeah. So for anybody that wants to check out my social media content, if they want to get in touch with me, chat, potentially look at a meeting together, consultation, whatever, you can find me on Instagram at James M. Kehler. Kehler spelled Kehler. So you can find me there. You'll see my content. You can reach out to me. I hope I try to make a lot of valuable content so that people can get something out of my content and not necessarily feel like, oh man, I have to work with this guy as an advisor. Maybe it's just tips and tricks. Like I know Farah, you'll do the same sort of thing. And I think that's really, I love making that kind of stuff. I love putting something out there that if it helps one person, that's a win for me. It doesn't have to pay me for it to be a win kind of thing. So you guys can find me there. Reach out if you have questions, whether it's from this podcast or just in general, or you just want to chat and talk shop. I'm always game for that. So.
Amazing. I'll have all of James's links down below for those of you who are listening or watching. If you want to get in touch with him or check him out, as well as mine, be sure to check me out on Instagram at farahturcott.ca. Subscribe and like and share this with your friends if you found that we brought any value to you guys today. Thank you, James, for joining me. This has been good. And I'm like, we've been chatting for a bazillion years, but it's been good stuff. Yeah.
Yeah, we finally got it done. I'm just, thank you for having me on the podcast. This is so cool. And I love that you do this and that you've got such a niche carved out for yourself here. So it's just super cool to be a part of this. And I thank you for the invitation.
Thanks for coming. Thank you.
You bet.